A very common problem that a lot of new traders face is mixing time frames. They'll mix short-term trading with medium-term trading principles and vice versa. And what I mean by that is, of course, trading the medium-term trend like this through here, or trading these little short-term uptrends and downtrends. And I vividly remember my first ever coaching client. This was exactly the problem that he was having. He was trading medium-term trends but using really close short-term exits. Therefore, on a regular basis, shortly after entering a trade, he would be stopped out for basically nothing or a small loss. And we all know small losses are fine, but when you consistently have small losses because your exits aren't in the right place and you're not having any profits, then that can be a problem. And that was certainly the case with him. So a simple adjustment of his exits and where he placed those made a massive difference, because his analysis and his identifying the trends was great. He was forecasting or predicting the direction of the trend and doing that on a consistent basis and doing that really well, but simply his exits being in a wrong spot or an inappropriate spot was causing him to lose money on a consistent basis. And if I just show this chart just as a very simple example, as I mentioned, this is a good solid medium-term uptrend, and we have a typical medium-term trend exit, trailing exit in place here. And you notice for these few months here, the trailing exit does a really good job of allowing the stock to move up and down within its trend and allow it to move all the way up to the top here before perhaps signaling an exit up near the top. But whilst one person may have held this trade for that entire time, you may have someone else who trades completely differently, so trades short term, may have held several trades in that exact same period. For example, we may have just had a simple little short-term uptrend trade here and then another one. For example, we may have seen this reversal signal. There's an inside day there on that particular day, an inside day, a reversal signal. We enter on this trade, and as we move up this short-term trend, we have our little trailing exits move up underneath the low of the previous day. And as we'd move to this day, which is another reversal signal, we've moved our exit up higher, and then on this day it's traded back down below that exit and therefore signaled an exit for our short-term trade. So we've held that 4 or 5 days, enjoyed the good solid short-term uptrend, but then exited. And in fact, as soon as we exited this trade, knowing we've seen a reversal signal here, we may have entered a short trade and traded it back down. Of course, our exit will just trail just underneath the price, and as we hit this day here, we would have triggered our exit and got out. So we may have traded this particular stock, and again down through here, maybe through here, maybe up this little short-term uptrend here, maybe this short-term downtrend here, and vice versa. So we may have in fact affected several trades, short-term trades, during this 2 to 3 month period, whereas someone else trading medium-term would have only traded it once. The key message is, don't mix time frames. Are you trading medium-term trends or short-term trends? If you're trading medium-term trends, your exits will be placed appropriately away from the price to allow it to move up and down within its medium-term uptrend, allowing it every opportunity to continue higher and continue along its medium-term uptrend. If you're trading short-term trends, you are more than likely not going to use exits this far away. You're going to use very close exits, monitoring the short-term trends and a change in those trends, and then exiting very, very quickly. The other thing to consider with trading short-term is, one, it demands a lot of your time, constant monitoring of price because things are happening quite quickly. But the other thing is, I don't think a lot of people consider, is you've either got to use a lot of money to enjoy very small percentage movements, or of course, like a lot of people do, you're using a leverage product, whether that be an option, a contract for difference, some leverage which allows you to enjoy the benefit of this short-term uptrend, which in real percentage terms in the price may not be a great deal. In fact, this little short-term uptrend here, whilst it's solid, is certainly less than 10%. So if you're trading just the stock alone, will 10% profit be worth you taking the risk in the first place? But if you bring in the leverage, then that 10% can obviously be worth a lot more, and it makes it worthwhile trading this little short-term uptrend and doing it consistently on a regular basis. But it's really, the key message is selecting one or the other. Don't trade medium-term trends and then use really close stops. Don't trade short-term trends, but then use stops that are a long way away. You really cannot mix the two and perhaps use bits and pieces. So make sure you select which one is right for you and then go for it.